Hey, Bowtie Nation, Joseph Hogue here with our Sunday live stream. Thank you for being here for another one of these. We used to call it Beer Money Sundays. I haven't been on the beer for a couple of weeks now. I'm on coffee today. But hey, wherever you're at, whatever you're doing, grab your favorite beverage, adult beverage or not, and let's get to it because we got obviously a hugely timely topic for this week, finding that next GameStop stonk or stock or stonk, however you want to call it, for the longer term returns. Because while I don't think that GameStop trade is necessarily over, the short squeeze on some of these trades that people have been playing over the last couple of weeks. While I don't think that's necessarily over, and I'm not saying you jump into those short-term trading ideas, but I do think there is a way to use this in your long-term strategy. I'm talking about finding some of those beaten down stocks with good long-term fundamentals, and then using some of these technical factors that we'll talk about today, some of those that are being used in those short squeeze trades, and using that in your investing strategy. So basically, you're getting the best long-term stocks you can with some downside support because they have these technical factors. So we're also going to share the results of my own little experiment in this short squeeze trade, as well as just a general idea of what's going on with GameStop, what's going on with these short selling strategies, and how to understand and explain that. Again, thank you for being here. I see a lot of people already in the chat talking back and forth. I love that. Love the engagement back and forth in the community. And these Sunday live streams are just my way of getting out and talking to you a little bit more face to face than we usually get in the videos, and taking off the bow tie and just relaxing a little bit. So looking forward to a good time, a good live stream, and thank you for being here. Before we get started, I want to invite everyone to join our the Bowtie Daily. That's our daily market update newsletter. It goes out the night before market opens, 9 p.m. every night before the market opens. Gives you that time to understand what's going on in the market, the most important news and trends and strategies there that you're going to find, and it's completely free. Something I've been wanting to do for a long time. Send that out to you out there in community every night. Just got time to do it this year, so we just started it this year, and over 8,000 people are already signed up and receiving that every night. So I've left a link in the it's pinned in the chat, and I'll leave one in the comments below as well. Look for that, sign up, and I'm actually also going to put in a link. A link to our private Facebook group. So if you want to join the private Facebook group we have there on Facebook, the Let's Talk Money Together group, then sign up, look for that link in tonight's copy that'll go out to 9 tonight, and you'll get that link. But I want to get started here because, like I said, this is some really timely information, some information that, I think a lot of you that have been a little hesitant to jump in on this GameStop trade, the GameStop stock, might be able to still use that information to better your long-term investing strategy. So let's start out with kind of what's happening. What is this? What's the GameStop phenomenon? Why is this stock 1,600% higher over the last month and 400% higher just in the last week, which is absolutely amazing considering. And we'll look at a chart on this. The GameStop hasn't gone anywhere anywhere but down since about 2015. It lost about 90% of its value from 2015 to July of this year or July of 2020. And just started really running in the last few weeks. So what's happening? What is short selling, and what explains some of this? And really, so short selling is basically just it's an investing strategy, and not necessarily all bad. I know a lot of people want to demonize the hedge funds and short selling and that kind of thing, but it actually adds quite a bit of liquidity to the markets, and the hedge funds actually help the markets price themselves pretty well. Basically, short selling is if you think a stock is going to go down as an investment, then you can borrow the shares. You don't have the shares. You don't invest in them. You can borrow them from another investor. You're going to pay that investor an interest rate, right, while you hold them, and then you're going to sell them immediately, right? So GameStop, right? Definitely it's not worth $325, and even the people investing it, I think, right now can agree that it's not worth $325. The company itself and their sales have fallen 30% in the last 2 years. They owe 250% more debt than the shares are worth, even right now. Okay, so shares $325. I can borrow those shares from another investor, pay them the interest. I can sell those shares for $325 each. And then the idea is that in the future, if those if that share price does come down, I buy it back for a lower price. Okay, so shares dropped back down to $4 a share, which is where they were just a few weeks ago. I can buy those back for $4 a share. I net that difference, 325 minus 4, and then I return those shares to the person I bought them from, right? So an opportunity to make money not only on the long side by investing in stocks, but also on the short side. And how this works with hedge funds is, traditionally, hedge funds have grown into a lot of other strategies now, but traditionally they used to be just that, hedging, right? So most hedge funds use a long short strategy, right? They're basically trying to take the market risk out of their stocks. Okay, so they are investing in stocks like Amazon, like Apple, some of the best stocks in the market, but they want to take that market risk out. So they're also shorting some stocks that they think are, the worst or not nearly as good in that industry or within that sector, right? So, if a hedge fund is long on Amazon or some other kind of digital retailer, right? But they want to hedge that risk. They want to hedge that e-commerce or the market risk. Then maybe they would short sell shares of GameStop, right? Because that would take out some of that traditional retailer risk out of the e-commerce play that they've got with Amazon. And whether they do it one for one or something else is another strategy. Some hedge funds will have most hedge funds will have an imperfect hedge, right? They want to be net long because the market tends to go higher over time. So they want their long positions higher than their short positions. So for every $100 of long position they have, maybe they'll only short $30 worth of stock, right? So they'll buy $100 worth of Amazon, sell $30 worth of GameStop. Other ones are market neutral. Well, they'll have a one-for-one relationship, right? Where they'll have $100 long in one stock and $100 short in another stock, or just $100 short in the market itself, right? They'll short the market index. And what you'll see is, this is kind of tied to why the market is selling off lately as well. Okay, the market had its worst week since October, down 3.3% over the last week, worst sell-off since October. And a lot of it is the volatility around this strategy. Institutional investors still account for 75% of the market. Okay, and those are not only your hedge funds, but your pension funds, your large institutional money managers, anything like that, right? They can still control about 75% of the daily trading volume. And with all this volatility, with not knowing, okay, who's going to be the next stock target that is just going to boom higher, then they're just basically covering their bets, right? A lot of these institutional players are taking off their long positions, waiting for a little bit more certainty in the market, and that's causing stock prices to come down. Also, though, specifically with these hedge funds, is if they want to maintain that hedged balance, okay? They want to maintain that one-for-one hedge where they've got $100 of long positions and $100 short positions. Well, they're being forced to close out their short positions, right? These attacks, these targets on these heavily shorted stocks like GameStop. A lot of these hedge funds are closing out their short positions because they don't want that risk, right? Well, if they close down that short position, they got to close out their long position as well, okay? Because if they want to maintain that same balance, they got to close out their longs as well. So what you see, and this is something that I'm highlighting in tonight's market update in the Daily Bowtie tonight, is that you'll see the top 10 long hedge fund positions. You've got bellwether stocks like Apple, Amazon, Google. The top 10 stocks there fell by 2.8% on Friday versus I think it was like 1.93% for the S&P 500. So those top hedge funds positions are falling faster because they're having to liquidate those positions. So, something to watch, especially over the next week as, maybe this GameStop phenomenon keeps on going and those hedge funds and other institutional investors are forced to really sell out and liquidate a lot of those even long positions besides the short ones. So now you got an idea of what short selling is. Now some stocks like GameStop is really the perfect example. Get a high short interest. Okay, everybody thinks this company is dead in the water. Like I said, sales have been down 30% over the last 2 years. They owe 250% more debt than their market cap combined. Uh, and they just don't have an answer for the shift in from that traditional retail to e-commerce. They just haven't been able to find their place in that market yet. So everyone bets against them, and it ends up being hard to borrow those shares, right? They have a low share count, and we'll go into how to find stocks like this, a little bit later when I show you how to apply this to your long-term investing, your long-term investing strategy. But they have a low share count, which means they have so many shares shorted, so many shares borrowed and sold, then it's hard to find new investors to borrow more shares from them, right? The borrowing costs for these get pretty high. Like I think GameStop to borrow those shares, it's up to like 50% or something margin, something like that. Over this last week, it's just exploded really. So it gets really hard to borrow these shares, especially when a large amount of people jump in and start buying the shares. Right? You get what's called a short squeeze. Okay, if you do start getting a lot of people buying up the shares, pushing the share price higher, then it starts a short squeeze. It's very hard for the shorts to come back in, buy back their stock to close up that position. So that's just going to drive the share price higher and higher, and it becomes kind of almost like a self-fulfilling prophecy. Okay. Now this kind of short squeeze usually occurs after news or an earnings event, right? It's something that acts as a catalyst to send the stock price higher at first. People start coming into the stock, pushing the stock price higher, and of course that starts that short squeeze. Right now, though, it's that Reddit, right? It's the Wall Street Bets Reddit forum where it was kind of a coordinated move, and I'm not saying that it was necessarily market manipulation or anything. Frankly, it's going to be extremely difficult, probably impossible for the SEC or the Department of Justice, anybody to go after any of these people, because it wasn't necessarily market manipulation as it was just coordination, as it was just, hey, let's all buy GameStop right now and some of these other companies. So not necessarily anything illegal about it. Is just a coordinated effort to push those stocks higher, and it's worked so far. GameStop is really obviously the most popular one so far, but it's also hit Nokia, BlackBerry, even American Airlines has benefited from this. And I've been, not necessarily bullish or bearish on American Airlines. I like Southwest better. I like some of the other airlines better than American over the past 6 months, just because American does have so much more debt, and that's why a lot of investors, a lot of institutional investors, have shorted American Airlines versus some of these other airlines. So classic hedge fund again. They'll go long Southwest and then short American Airlines, right? So they're basically taking out that airline risk, that broader airline risk, out of the investment, and they're just betting on that one solid company. Okay, with that short position. Can this keep on going? Yeah, GameStop's up over 400% in the prior week. Washington, the policymakers really don't seem to have an answer to it. Obviously, I think Robinhood got burned when it shut down its trading in these stocks, and it's still very limited. So I think that's kind of a warning shot for a lot of these platforms not to shut down that trading. And it is pretty profitable so far. So I don't think that's something that's going to limit the trading in this, the GameStop trading and the stock going higher. My guess, though, is it can go on a little bit longer until the short interest clears out, right? Short interest in GameStop is still pretty high. It's still about 80 or 90% of the shares available. So obviously, that's still going to lead to short squeezes and the stock going up if enough investors push into it. But you're going to have things like Thursday when GameStop was down 40, 60%, and it's going to burn enough people that they're going to be once bitten, twice shy, right? If as enough people get into these kinds of investments, into these kinds of stocks, and they get burned by it, they lose 50, 60% of their money in one stock, then they're going to think twice about going after it again, and that's slowly going to gradually grind down on the strategy, and it's just going to stop working. Okay. and we'll talk about some of the other risks and stuff like that. So I want to actually share before we get to how to kind of build it into your long-term strategy and some of the things I would look for in that. I want to share kind of my own experiment that I did this week. Started it this week, and I think it was Wednesday. Wednesday I went in and I bought shares of 3 companies. Okay, and I used a lot of what we'll talk about today to find these companies, but a little bit more than simply what everybody else is talking about, what everybody else is using, like GameStop, BlackBerry, Nokia, that kind of thing. What I wanted to do was find companies that were not only good short squeezes, right? Had that high short interest, had the low share count, things like that, and the low market cap, but also companies that maybe had a little bit stronger long-term potential, as well as some other factors. So I went in, I bought shares of B&G Foods, that's BGS, PLCE, that's Children's Palace, and Tanger Outlet, right, SKT, and and you can see, you go through each of these, and you can see, so BGS had short interest as a percentage float. It's 36%, not quite as high as some of these others, but institutional ownership, that means, what percentage of all the shares outstanding are owned by institutional investors. And that's important because, these institutional investors, you've got, besides hedge funds, you've also got all the indexes, all the ETFs, right? So all the ETFs that own these shares, they don't sell often, right? These are long-term investors that generally don't dump their shares, on a week-to-week basis. So it's fairly stable ownership. And if that's high, then that means the shares available of this, you can see the shares outstanding for this stock, BGS, is only 64 million shares, right? Which GameStop is 69 million, right? That's one of the reasons why it has really jumped as high as it has, is because, first of all, there aren't that many shares outstanding. So you get 100,000 people buying 1,000 shares each. That's taking off a significant amount of the number of shares outstanding and even available from the market. And it just makes, the ability to buy back those shares that you've sold short, it makes that harder to do. So, if you've got a high institutional ownership and, that high short interest, that's just going to make that short squeeze all that much more easy to push. You look at some of these other ones that I did. Children's Palace is, only 14.6 million shares. So about a quarter of the number of shares outstanding as GameStop or some of these other stocks. Short interest as a percentage of float is 37%. And then, Tangers, or there we go. The outlet stores, you have 50% of shares available are shorted. Okay, 93 million shares outstanding, so a little bit higher there, but still a strong institutional ownership of those shares. And what I was looking for, especially, and I think how this plays out for a lot of these companies, is a lot of these companies, especially the retailers that were on the verge of bankruptcy, GameStop is probably going to be the perfect example. I think GameStop, when it reports its earnings the end of March, I think March 26th, I think it is, maybe February 26th. You want to check that if you're in this trade. Then they're going to announce a share issue program, right? Companies, especially these in the short trade, have been taking advantage of this to sell more shares out into the market and really raise cash. Okay, there is no way GameStop over the long run will ever see $325 a share again, right? So I guarantee you, management is thinking about taking advantage of this, issuing some shares in the market to to provide that easy funding over the next couple of years as it figures out, okay, how do we compete in this e-commerce environment? Okay, so that's actually an upside that I was looking at to some of these. BGS Foods, obviously pretty well positioned in the consumer staples space. Children's Palace and Tangers, though, within that retail space, that traditional brick and mortar retail space, they definitely need the funding, and I think these higher share prices do help them at this point. So a long-term play on these stocks. And I got out. I ended up holding those positions for the day. I sold them the next day, actually around 10:30 the next day. and made about 470 bucks, right? And it really confirmed. I mean, I wasn't in it to make money. I'm not generally one of these short-term trade strategy kind of guys. I wanted to really see, what it does to you, and it just kind of confirmed what I was looking at. And anyone that's been investing in these, you've seen it. Okay, it's that stress. Thursday, most of my scripts were written up. It was supposed to be a pretty easy day, and it ended up being just a all day stress fest. Checking back on social media, checking the stock prices on these all night, wondering where the stocks were going to open up in the morning. And it wouldn't have been worth it if I had made $1,000 or more on the stocks. Let alone just under 500. So, for a lot of you out there looking at these kinds of trades, you got to ask yourself a couple questions. One, is it going to be worth it? Do I need that kind of get rich strategy? Okay, because I mean, getting rich, folks, let me tell you, it's not going to make life suddenly easier, okay, or suddenly more happier. Okay, you still got to do something with your time. So why don't you spend a little bit more time figuring out what you like to do for money, what you like to do and how to make money on that, than trying to, some bullshit FIRE movement, retire early and then have 40 years of you just sitting in front of the TV doing nothing. Okay, so, is it really worth the stress of every night having to worry about, is this trade going to destroy 60% of my portfolio? Because it will. There's really two outcomes to this type of trading, okay? One is you lose. You lost your money. You had that stress, but you learned a lesson, right? You learned that there's no free money, no free ride in this market, okay? And that can be painful. Worse yet, though, sometimes is if you win, because then you're going to get addicted to that. You have a few good days, you make some money on that. Maybe you start out with $1,000, you build that to $5,000. Five times your money in, I don't know, a week, right? Which is ungodly, unheard of, in the markets, right? 5x your money in a week. But you just keep on playing it. You become a crack addict for that kind of a return, and you're eventually going to lose big, okay? You're going to get to a point where, okay, so now you've got $5,000. You've still got it 100% invested in these stocks, and then, you have one day where you lose 60% of your money, 50% of your money. You're down to 2,000, maybe 2,500 now. You've lost half your money, and at this point, that gambler's mentality kicks in, because now you're just trying to get back to where you were. Okay, you're trying to avoid those losses, and you just got to get back to even, right? So you're looking for those other stocks that are gonna get you even though you're still up, 2.5 times your investment over maybe a week or so. You're still looking at that higher bar and trying to get back to even. So you're constantly going after that. And, eventually you're going to lose your money, dude. And you're going to have paid all this stress for it. You're going to have missed out on so much other stuff that a lot of times it's just not worth it. So, you know what? You really got to think about this and really how you want to play it. I don't want to tell you not to do it because, hey, there are some people making money. I'm seeing in the Facebook group as we speak a lot of people posting on there. It's been great for some people, but others, one guy, he's down 38% already over the first few days. So that kind of loss, especially if it's on a large part of your portfolio, that can really bite you. And again, once bitten, twice shy. How long is it going to take for him to get back in the market and make that money up and then go from there? But since we're talking about a kind of a long-term strategy, I want to I want to share how you can actually use this with kind of a long-term idea, that long-term strategy, how you can fold this kind of idea into your long-term investing strategy. And what I want you to do is you're going to look at just a few of these factors that the short sellers are using, right? You're going to look at a few factors like the short interest, and I'm going to show you how to find all of these next. You're going to look at that high institutional holding, right? So what percentage of the shares available are held, or what percentage of the shares outstanding are held by those long-term institutional investors. You're going to look for the share count and then some ideas on screening for this next GameStop stock, right? The market cap, the low share count, and that kind of thing. So if we go into Yahoo Finance, and we'll just use GameStop here because it is kind of the perfect example for this. First you're going to look at you can look at the share count, and we looked at for some of the some of the stocks that I was looking at saw that low share count. But here you just want to look for the market cap of the stock, right? The market cap is the total value of all the shares outstanding for that stock. Okay, so it's the stock price times all the shares outstanding. So if you want to find how many shares a company has outstanding, you would just do the inversion of that, right? You would just get the market cap and the so the market cap here for GameStop is 22,668,000,000. Okay, that is right now the total value of all the shares outstanding. Divide that by the share price and you get 69 million, right? So 69 million shares outstanding. That's the number of shares issued by GameStop, and that's actually a very low number. Okay, you look at a stock like Apple, right, which has in the trillions, market cap in the trillions, $2.2 trillion market cap. Okay, so let's do it for that one. 2,215 billion. Okay, and so we'll make it into millions, make it comparable there. Divide by $132 share price. Apple has 16,780 million shares available, or shares outstanding. Okay, so 16.7 billion shares. That's compare that to GameStop is divided by 69. That's 243 times the number of shares GameStop has issued. Okay, so you can see why, GameStop, with only 69 million shares available, if it gets millions and millions of people buying shares, it's going to obviously be a huge factor in how that share price moves. Apple, not so much. If 69 million new investors come into Apple, that's only, that's a very small, that's only 1/243rd of the shares issued anyway. Okay, so first you want to look at how many shares issued a stock has. Then you want to go to, we'll go back to GameStop. So we have our example there. Then you're going to go into something like this. So Yahoo, you can find it in some statistics, and you're going to want to find the short interest and the institutional ownership. Okay, so in Yahoo, and this is available on any trading platform, right? I used E-Trade in our earlier examples, but you go to share statistics, and you can see, okay, so of GameStop, how many shares are held by insiders? How many shares are held, or what's the percentage of the shares available or outstanding that are held by those long-term institutional investors? Okay, and then what's the shares shorted, and then what's the percentage of float that is shorted? Okay, now the float is just those shares that are issued, the total shares issued and outstanding minus the institutional ownership. Okay, so what percentage? What percentage of institutional ownership is there, and then the shares shorted divided by the shares float. Okay, so what you want to do is you want to look for that low share count. You want to look for a high percentage of shares held by institutionals, and I think this is wrong. There's not necessarily 122% of the shares issued owned by institutions. I would go with probably a broker platform that keeps stuff a little bit more up to date. But this is probably around 70% for GameStop, and then you look for that high shares percentage of float. And this is probably wrong too. This is older data for them. So I think with GameStop, it's still around 80 or 90%. Okay, so for that high shares shorted percentage of float, you want to look for something above 35%, preferably above 40 or 50%, to really cause that short squeeze. If you're not, if you're trying to force that. Then you're just going to look at a few screening things that I like to look for in some of these companies, right? So we saw with GameStop, it's right now a $22 billion company, right? But before all this happened, it was, so 325 divided by 4, it's 81 times larger than it is right now. Okay, so 22.2 billion. It was only a $274 million company when this started, right? The total market cap of the shares, $274 million. That's really what you want to look for. You want to look for companies with a market cap under maybe a few $1 billion, okay? Because honestly, well, like we saw with Apple, with a market cap over $1 trillion, Even a million investors rushing in there with their $500, their $1,000, that isn't going to be, a fly on the ass of Apple. Okay, they're not going to move shares of Apple. Even that large influx of investors, but you get a million people, a million new investors, with $274, and that would have just doubled the market cap of GameStop. So you really want a company that has that potential to be influenced, to be leveraged with new investors. So you're going to want to look for market cap under a few $1 billion. I would say under 2 billion, probably maybe 3 billion. You want to look for that low share count and the high institutional investors, right? As well as the high short interest. So what you want to do and how you use this in your long-term strategy is you want to go to you really want to put it into your fundamental analysis, right? So first, and I would say first is doing your fundamental analysis, picking out those good long-term stocks that you think have good long-term potential, and then using these factors to narrow down your list, right? To narrow down that list to maybe 5 or 10 or 15 companies at the most that not only have those good long-term potential, but also the low share count, the high short interest, and the high institutional holdings, right? As well as the low market cap. So using those both in conjunction, not necessarily just jumping on, whatever next stock someone is pumping in the chat or in a social media post. Okay. Because honestly, a lot of times, and I see a lot of people trying to pump stocks here in the chat. And hey, I can't bash it because that's how it started, right? That's how it started with GameStop in that Reddit forum. People were, hey, let's all invest in GameStop, and everybody just invest in that one stock, and that's how it started. But anymore, you've got so many people pumping so many different stocks, it's just not working. You might get you got pretty good movement in GameStop and a couple of these other ones Friday. Like I think Naked was another one. I think Nokia did okay, but generally, all the force behind this surge in retail investors is spread out over so many stocks that it's just not working like it used to. Okay, and that's when you start losing money in this. So that's kind of how you use this, and I want to open it up to question and answer. I see some questions in here. If I don't see your question, go ahead and ask it again with a question mark, so I see that it's a question. And if I don't get to your question, make sure you ask it in the comments section of the video, and I'll try to get that to that as soon as possible as well. What else? So, I see a lot of people talking about silver as the next big short squeeze. That ain't gonna happen. There's just the market cap for silver, especially like the index fund, and we can look at that. We can look at that right now with the silver index fund. A lot of people saying SLV, right, which is the iShares Silver Trust, and you can see a market cap. Yeah, a market cap for this stock is already $14.8 billion. Okay, there's average volume is 31 million shares traded daily at $25 each. Right, so let's just, when you're looking for these, you just kind of do the math and think, okay, you know what? Is even a million new investors going to be able to move this stock? And with this, okay, if you've got $25 times 31 million. That's almost $1 billion in trading volume a day on the stock, just on average. Okay, and while we did see trading volume spike up quite a bit on Friday, so 113 million shares traded times 25, it's about $2.8 billion, right? It only pushed it up 1%. Okay, folks. So trying to target these high market cap, high average volume stocks or even funds, it just isn't going to work. Okay, you need to stick with the ones that are lower market cap, are lower shares traded on a daily basis, already have that high institutional ownership and the short interest, and and go from there. Now with this, I mean, I can tell you there's probably a high amount of short interest in the silver index, but it's just because people are using it as a as a hedge. Okay, they're using it as that market hedge against maybe some of the silver mining stocks. Okay, so not necessarily the same thing that you see with GameStop and some of the other stocks. Okay, what? Let's see. 200 ruble thing there. I appreciated that. Thank you very much. I hope you're doing. What do you think about gold and the miners? Also, it would be great to hear news about the market and a possible correction. Okay, great question. Let me go ahead and address that. So first, gold and the miners. I mean, I think gold is probably a really good safety bet right now. It's obviously, got two factors behind it, two good long-term factors, which is going to be, the weakening dollar and higher interest rates and inflation. Okay. Honestly, you just can't push $7 trillion into the economy, which it's about to be like $9 trillion. The amount of money the Fed's pumped into the market, the amount of money that the government has pumped into the market in stimulus and the coming stimulus package. You just don't push that much money into the economy and expect there not to be an inflation. Okay, inflation expectations over the next 5 years rose to about 2.2% over this past week, which is still pretty comfortable for the Fed, but it's going up, and it's going to go up, especially as people get out. People have been saving 13% of their disposable income. That's the household savings rate that we've seen reported by the Fed, higher than any time over the past 5 decades. Okay, and that's really pushed stock prices up. It's pushed asset prices up. But you got to think, okay, what's the next shoe to drop? Okay, as an investor, you can't just say, okay, what's the data already released? Because that's already priced in the market. You got to say, where is that data going, or where is that taking us? Okay, and when I see a high savings rate like that, people got all this money, they've made good returns on their stocks. When they finally do get out and they start spending that money, what's that going to give us? That's going to give us high inflation. So inflation is going up over the next 6 months to a year. That's going to take interest rates up. I don't think the Fed is going to do a whole lot about it because they're still kind of dovish and want to keep those interest rates lower. So you've got interest rates anchored, especially at the low end. That's going to cause the dollar to weaken. Okay, so yeah, gold is going higher. And if nothing else, it's a volatility hedge or a safety hedge against this volatility. Now, the way I like to play it, instead of just betting on gold, which pays you nothing while you hold it, I usually own the miners. Okay, so you can look at the miners, the gold miners, even the silver miners, because it's related there. And I think you'll do well, not only as a safety play against the stock market, but also just on that inflation on those gold and silver prices. As far as a market correction, again, like we talked about last week in our live stream, the market is undeniably expensive, even with interest rates so low, especially as interest rates start creeping up a little bit. You're going to see some of that enthusiasm come out of the market. Now, I don't think we're heading for a crash, though, because, even with a very expensive market, even with all the institutional investors selling out of the market, then what you got is, you've still got all that savings going back into the market. You've still got, or into the economy, right? You've still got record low interest rates. And the market generally doesn't crash when there is when there's rising economic tide. Okay, we're seeing expectations for 5% economic growth in the U.S. this year, maybe 6% or a little bit higher for the global growth. So stocks don't generally crash during that kind of a period. But, I do think you see some kind of a correction, 10 to 15% here in the next month or so, 2 months, as, the market figures out what's going to happen with this whole GameStop trade and where that's going. So definitely, I would, and this is another thing that I'm detailing a little bit more in our Bowtie Daily tonight, going out 9 tonight. So make sure you sign up for that. I do think you get hedged a little bit here with your downside. So maybe selling those covered calls, maybe buying the puts against the S&P 500, so the market. So you're getting that market protection. But then I think over the longer term, as people start getting out, as the vaccine is distributed, and we get a little bit, closer to that economic growth, then I think that's going to support the market for this year, and it'll end higher. What else? What good opportunities do you see for finance majors. Sprott ticker SII. Okay, good opportunity. Okay, so Drilly wants to know about good opportunities for finance majors. Honestly, for anybody just getting out of college, anybody, you got to find some way to make money online. And I know I'm biased because that's my job, that's what I do. But those traditional jobs, those traditional in-office jobs, they're not going to give you the kind of control. They're not going to give you the kind of freedom or way to express yourself through your work, and you're just going to feel stuck. Okay, that's what I did 10 plus years in the corporate world until I actually started building my own online assets, whether it's through a YouTube channel, whether it's through a blog. So I would find a way to do what you love doing, work in finance, but do it online, whether it's through consulting, freelance, an online analyst. That's how I started. I started, taking my analyst skills and providing that freelance analyst to a lot of the people that I knew that worked on Wall Street didn't want to write up their own reports, so I wrote them up for them. Okay, so do that. Sprott, I really don't know the Sprott. I don't know what Sprott is, so I can't really tell you a whole lot on what what the outlook for that is. Financial services, asset management. Right now, asset management is doing well. I think they're probably not hiring a whole lot because of the current uncertainty in the market. But last couple of years, asset management has done very well with just the retail trading environment, and so it's been a pretty good career path. What other questions we have here? What do you think of Fubo TV? Seems to have a long shot fundamentals and high short interest. Okay, yeah, Fubo is another one that I've seen bounced around a lot as far as these kinds of short interest stocks. And so your ticker is FUBO, Fubo TV. And we'll just look at the profile here. So this is broadcasting, okay? Which, I mean, it's that old content. Broadcasting TV. So I would kind of wonder, if they're able to do much. So it's a live TV streaming platform for live sports events, news, entertainment in Europe and the U.S. Obviously, if you're anything in sports events, it's had a rough year. If it doesn't have what I would be looking for in these, supposedly rebound stocks, these stocks that have that high short interest, you got to understand, folks. These hedge fund guys, they're not stupid. Okay, it's a $3.3 trillion industry, hedge funds. So they hire the smartest analysts out there, and the reason why they're shorting these stocks, there is a reason. Okay, so if they're shorting this stock, it's because obviously sporting events has done nothing over the last year. What I would want to do, I would want to look in statistics here and look at their balance sheet. Okay, look and see if I think maybe they have the financial stability or flexibility to survive at least over this year with almost no revenue, right? With no earnings this year to survive until those revenues come back up. So here, they've got $38 million in cash against about $46 million in debt. So that's not a bad financial position. I would want to compare that cash with maybe their operating costs year over year. Make sure that they have enough cash set aside to be able to pay their operating costs this year, and as well as those interest expenses. So I would want to do a little bit of analysis here. It does have a high short interest, so 58% of the shares outstanding are shorted, and it's it's a fairly low. I think shares outstanding 67 million, so a fairly low share count. The market cap here is only 4.6 billion, so not a large company. I think it's actually benefited from this short trade here over the past month or so. So not too much. Now, what I would say for, again, doing your fundamental analysis for that long-term idea is, okay, streaming is hot, but can it really compete with some of these larger streamers? Okay, so if it's trying to compete in that TV broadcast streaming space, does it have the licensing right to a lot of these sporting events that people actually want to see? Okay, so it's in sports, it's going to have to compete with Disney and its ESPN. It's going to have to compete with a lot of these other companies that have those streaming rights, have the digital rights to some of the big sporting events. So pay big attention, or pay a lot of attention to to its competitive advantage if it has one, and how it can actually survive and turn that into a long-term market share within that streaming space. Again, I think as you're looking at these, I would make these technical factors like the short interest and the share count and the percentage of institutional investors, that kind of thing, that would be secondary. I would want to make sure I have a good long-term company that I want to invest in, and then use those short factors, those short interest and those technical factors as kind of the narrowing thing to the funnel to narrow down my list of stocks to invest in. Okay. What else? What do you think about Great Natured? I don't know Great Natured. Yeah, I see a lot of questions about individual stocks, and if I can't do the analysis real quick on these, I'm not going to recommend them or not just over the next 30 seconds that I can look at the stock. What else? Would you take some of these stocks and wait for sell off some of the stocks and wait for a 10 to 15% correction and then buy in? So a great question from Kyle. Kind of idea of, okay, so if we are thinking about a sell off, a correction in the markets, what do you do? Do you take some of the profits and then wait for that correction, then buy in? How do you decide that? And really, what I've started doing is, one, I've got covered calls on most of my long-term stocks. Okay, so stocks that have come up quite a bit, even to or past my fair value estimates, then I'll sell covered calls on them at a higher price, right? That still gives me the opportunity to book some future returns, book some returns over this year, or even over to July. So maybe sell those July covered calls, but then hedge my downside, right? I can cash flow those investments as well. Those of you that saw the Friday video, right? Friday video is a great example of this. What I'm doing, I've got upwards of about $300,000 in cash, right? And that's beyond the long positions that I've got covered. That's beyond bonds and real estate and a lot of other stuff. But, I'm earning zero on that cash. So what I'm doing with it instead is I'm looking for those very stable, those stable long-term stocks like, CVX was the example we used in Friday's video. So Chevron, got Pfizer, you've got like things like Altria, which is ticker MO. These long-term stable cash flow stocks. Okay, we're not talking about anything in tech. We're not talking about anything in biotech or anything like that. We're talking about stocks that are, those relative safety sectors. Okay, so obviously some of the things that we've been looking at. And I'm selling deep in the money calls. Okay, and I don't want to go into too much detail in here because you can watch Friday's video, see exactly how I set this up. But basically, I've got a 13% downside in Chevron, shares of Chevron, before I start losing any money. Okay, I'll make 13% on that as long as the shares don't fall more than about 13% to January of next year. I'll collect the 5.6% dividend yield plus 7% that I sold on use those covered calls to sell. Okay, so it's a great strategy to use your cash, get a little bit higher return. So like I said, I'm making a 13% return on my cash instead of just having it sit in there waiting for that correction. Okay, so I do think you take some profits in some of your stocks, maybe sell some covered calls against some of them, and then use that cash to earn a good dividend yield and a good hedged, protected yield on those covered call strategies. Okay, I'm sure any free tools out there. Last day of trading. No. Nokia. Oh my God. I see some of these comments with just emojis is all they are. I mean, come on, just stop. It does no good. What do you think of PSTH and Bill Ackman? Never been a huge fan of Bill Ackman's. I mean, he's a smart guy. I think he tries to be a little bit more of a cult of personality than he should. But he's a smart guy and he's a great hedge fund operator. I think we recommended his PSTH SPAC about a month ago. So let's see what it's done. PSTH. Pershing Square Tontine Holdings. It's the hedge fund that Bill Ackman is running. We recommended it. I'd say probably a couple of months ago in our SPAC video. I think it's probably right around here in December or so. So it's up a little bit since then. It's up probably about about 10% since then. I like, I mean, the SPAC space, there's just no holding it back. And until the market really does, take a nosedive, I think these SPACs are going to be a good retail investor target. I think why you're seeing a lot of weakness in these right now, and it's going to be in a lot of those momentum plays. Okay, so you've got the SPAC stocks, you've got Bitcoin. If Elon Musk hadn't talked it up on Friday, you've got the ARK Invest funds. A lot of you are seeing these momentum plays over the last few months. They're coming down in this last week and coming down harder than the general market. And of course, that's just because they're not the flavor of the day anymore. Okay, all the all the retail investors that were looking for that momentum strategy, all the institutional investors that were playing that momentum strategy, they are now moving on to GameStop and Nokia and BlackBerry and that kind of thing. And so that's of course taking out a lot of the interest in these SPAC stocks in some of those other momentum trades. So I mean, I do like it a little bit better than some of these other momentum stocks, but that's the thing. If you're looking at a sell-off on this higher uncertainty and on these hedge funds that are having to close up their bets, long and short, then it's going to hit a lot of these other momentum trades. What else? What do you think about Johnson and Johnson? I'm just going to ban this guy from the chat. Hide user. There you go. So I saw somebody ask about Johnson & Johnson. I like Johnson & Johnson as a long-term play. Their vaccine results the other day, released Friday, that was only 66% effective. Was a little disappointing. Now, understand that's on one dose. Okay, so the way Pfizer and Moderna, a lot of these other vaccines are able to get that 95, 96% of efficacy on their vaccines is because they've got 2 doses, right? They give you the 2 doses, and that builds them to that. Johnson & Johnson, it's a one-shot dose. It doesn't have to be stored at these temperatures like the Pfizer or the Moderna vaccine. So I think it's going to be taken up a lot faster than a lot of these others. So I think that's positive. I think I don't think they did quite so well on their earnings and on on that. So yeah, it did. Shares dropped about 3.6% on Friday, and so over the past month they're down quite a bit. I think this big drop here from 170 down to 165 was on earnings. So they're down about 5% from their from the peak here just a couple of weeks ago. I think it's an opportunity. I think it's an opportunity to get in on a strong long-term stock. It's only paying 2.5% return or dividend yield, so that's not great. But if you do like the stock, if you are looking for a long-term investment, I think this is a good opportunity to get in on Johnson & Johnson. And I think that vaccine does help it support the bottom line. Once it gets approved and out there. Yes, a little bit lower efficacy, but it's only one dose. It's going to be easier to distribute and store and all of that. So I think more people, especially the emerging market countries that are looking for a vaccine that aren't able to get the other ones, I think they're going to be using that more, and it's going to help the stock. So good question there. Okay, I saw somebody ask, what do you think about ARK-K, which is ARK Invest, their major fund. They're the ARK Innovation Fund, right? ARKK is the ticker. That's the ARK Innovation Fund. And again, I know that's going to be down. I just, down 2% Friday. And, so we're looking at a high of about 150 about a week ago, down to 137 now. So, 13, that's about 10% down from its peak. And this is what I'm talking about. There's 2 things at work here for ARK, the ARK Innovation Fund, I think. One is just that sell-off in momentum stocks. Okay, and that's really what this is, this innovation ETF. I mean, it's really great research by Kathy Wood and her team over there at ARK Invest. But that's been the theme this last year is that innovation, the tech, biotech, a lot of those names. So it's this momentum stocks that they're investing in that are coming down, and that's hitting the fund. Also, if you're investing in these ARK funds, especially any of them other than the ARK-G, right, the genomic one, that one doesn't own shares of Tesla, but all the other ones, if you own those funds, you understand that you don't need a lot of Tesla stock also, okay, because you're already exposed to Tesla stock. Each one of these funds has about 10% or so of shares in Tesla, okay, 10% of that fund in Tesla. And what you do, this is interesting. If you go to, and I'll do this right now because this is a really interesting thing you need to do with your investments. Go to the sector tracker or go to the sectorspider.com, right? And these are some great tools. You can see what the sectors are doing on a daily or weekly or monthly basis, whatever. So you can see the best sectors in the market. You can see the best stocks in each sector. But you can also go here to tools, and they've got this correlation tracker. And this is important because correlation is what's going to show you, how your stocks are moving together. Okay, so it's really going to help you with that idea of diversifying, limiting the risk in your investments. Okay, and if you want to go to something like this, multiple securities, and let's do something here. Let's compare this some of these ARK funds, and I think what is some of the other ARK funds? The ARK-G is genomic. I know that one isn't highly highly correlated. Okay, so you've got the ARK-K, the ARK-Q, which is autonomous tech. ARK-W which is next generation internet. Let's do those three: ARK-Q and ARK-W, and then we'll do Tesla. Yeah, for some reason it's not. Okay, we'll just ARK-W. Okay, and now what this is going to do, you can see what kind of correlation these funds have with each other as well as with shares of Tesla. And what that is, correlation runs from -1 to +1. Okay, +1, the very highest it can be, means those investments are going to be exactly, dollar for dollar run up, okay, or percentage run up. If if one investment goes up 2%, the other one's going to go up 2% as well. Okay, they're going to move in lockstep. If they have a correlation of -1, then it's going to be just the opposite. Okay, if one goes up 2%, the other one's going to go down 2%. And if one goes up 10%, the other one's going to go down 10%. Right? It's just how those investments move together on returns. Okay. And so what you want to do in your investments, it doesn't make sense to have two stocks. Say you have two stocks and they have a perfect 1-to-1 correlation, right? 1.0 correlation. It doesn't make any sense to have that because, one's going to go up, the other one's going to go up the same amount. The other one, if they both come down, they're both going to come down same amount. So it does nothing for your portfolio. You might as well just invest in one and not the other because it's going to give you the exact same amount of returns. What you want to do, you want to have stocks in your portfolio that aren't perfectly correlated with each other. So basically what you're looking at for stocks in your portfolio that have a correlation of less than maybe 0.3 or 0.4, right? That means that as one stock goes up higher, maybe 3%, then yeah, the other one might come up, might come up 1%, 2%, whatever, but it's not perfect correlation, right? On the same token, if one comes down, crashing down 5 or 10%, the other one isn't coming down the same amount, right? It's not perfectly correlated with each other. And the point is, what you see here is if you're in these ARK Innovation ETFs, any of these ARK funds that own a lot of Tesla, right? If you compare them to, so Tesla with the ARK Innovation Fund, 0.78%. With the ARK-W, with the Next Generation Internet Fund, 0.8% correlation on that. So basically that means you're kind of getting the same thing. If Tesla goes up 5%, the ARK Next Generation, the ARK-W, probably going to go up around 5% too. If Tesla comes down 5%, it's probably going to be about a 5% loss on the ARK-W as well. Not saying that they're not good investments. They're not both, Tesla's a well-run company. Kathy Wood's doing a great job over there at ARK Invest, but it just doesn't make a whole lot of sense to own both of those, especially in high amounts. If you've got 20% of your money in an ARK fund and 20% in Tesla, you basically got 40% of your money in pretty much the same investment. So just something to watch for, when you're investing in those ARK funds. Again, though, I do think you see some weakness over the next week or so as those momentum trades, as those momentum stocks come under some pressure like they have been lately. But I mean, it is a way to get a good good exposure to some of that professional management that they've got over there. Maria wants to know about Workhorse. I like Workhorse. I own shares of Workhorse. I think within the EV space, within electric vehicles, there hasn't been quite as much attention, of course, until just about a week or two ago, hasn't been quite as much attention paid to the truck or the commercial vehicle, the last mile kind of stocks, and that's really where the first money is going to be made. Okay, passenger is great, but we just don't have the recharging stations. We don't have the technology quite there yet. The last mile, so that delivery, FedEx, UPS, the postal service, they need these electric vehicle trucks right now, and I think they're going to be paying for it, and I think Workhorse is probably going to be one of the best to benefit from that. So I do like that. What else? Super chat there, $5 from Schaefer. I appreciate it. If I don't own 100 shares of a stock, is buying calls a good option to juice up returns? How do you find a good stock for that? Okay, so great question from Schaefer there. If you don't have enough money to buy 100 shares of stock, then obviously you can't do a covered call because one call contract is worth 100 shares. In that instance, you got to kind of cover or you find your stocks that are cheap enough where you can buy 100 shares and do those calls. Like I said, some of the stocks that I like. Let's see what Pfizer is at right now. You can try Pfizer. I think that's about $25, $35 right now. 100 shares of stock wouldn't be too bad. $3,500, to buy 100 shares of that. I think Altria is a little high. I think that's about $90, $80, $90. CVX, no, Altria is not bad. For a stable cash flow stock. And I know a lot of people kind of have a hang up about investing in a cigarette maker, and that's fine. You can find a different stock, but we just saw cigarette volumes level off, actually grow like 1% for the first time in 3 or 4 or 5 years. Okay, everyone in lockdown wanted to make sure they had their smokes, right? So the first time in years that cigarette volume, especially in the United States, anyway. Leveled off, actually rose. So I think Altria can have a very good year. It's paying like a 7% dividend, 8% dividend yield. So a strong dividend, and a solid share price. But again, if you're not able to buy those $5 or those 100 shares, to use the covered call strategy, then you'd have to find another stock. Josh wants to know about the cannabis sector. Is it saturated or still at early stages? Great question. We actually did a video about 3 or 4 months ago on cannabis stocks, and the outlook for that industry, and was right on it. The states are leaning into a cannabis regulation to cover those funding gaps, and obviously with Democratic control of the White House as well as Congress, then we're going to see a push towards legalization, decriminalization, that kind of thing. So I think it's still in the in the early stages. I think you can still get in this. I think there's still momentum in that. If you've got any questions as far as specific companies, then you can ask on that one. What else? Canopy Growth. Okay, so let's look at Canopy Growth. That's ticker CGC. And, this is one of the larger ones. And I would generally, especially within these themes, I would generally defer to the larger cap companies. So Canopy Growth, especially these ones, $14.9 billion, especially these companies that have the large investors from other companies. So I know Altria is invested in, I think Canopy actually. I know some of the liquor makers, Constellation Brands is actually owns about 30 or 40% of one of these, and one that we highlighted in that video a few months ago. And what that is basically it's just an option to buy the company. Okay, so Canopy Growth, this other company that I can't remember which one it is. Altria owns about 45% of one, and Constellation Brands owns about 25-30% of the other. but it's basically just, a hedge if these companies, if Altria wants to buy this marijuana company, if Constellation Brands wants to buy this this other company within the next year, they've got enough shares, enough controlling interest that they can force that deal. So it's a great situation for these cannabis companies, because they've got a deep pocket investor that's going to always provide the funding that they need, and now they've got that big backdrop behind them. So back here in around September when we did our video, so they've about doubled. Shares have about doubled since then, since that video. But I think this is a good long-term trend, especially at least for the next year or two. We get that hype around new regulation or new legislation, and I think some of these can go up higher. I wouldn't stick around for much longer than maybe $60-$65 a share on these. Maybe cover them with some options there. But over the long term, they can go higher as well. Okay. What do you think of Tyson Foods? Now, I haven't covered Tyson in a while. I can tell you some of these consumer staple stocks have sold off over the past month. So Tyson Foods. And what we're seeing is in a lot of these, especially the consumer staples companies like that sell the household products. Okay, so we actually added Clorox last week into our 2021 portfolio there on Stock Card. We added Clorox. It's up like 13% just in the last week. But a lot of these companies have been selling off because people are worried as people get out, as the vaccines get distributed and people get out, they're not eating as much of that food in their house. They're eating maybe at restaurants. They're not using as much toilet paper at home to wipe their ass. They're wiping it at restaurants, that kind of thing, or whatever. So a lot of these consumer staples companies that have done so well over the last year in these lockdown situations have come down quite a bit. Tyson. Let's see where Tyson is over the past year. Tyson's really been hurt, and a lot of that I think is just on kind of the working conditions. Some of the plants, some of the processing plants there up in Iowa where I'm from and around there have really been hit hard, by the lockdown, as well as just not being able to have people to work in that closed, confined space that they usually have with that meat processing, and they haven't really rebounded. Now I do like Tyson. Seeing this, I do like Tyson on that valuation. I think there's still enough control in Congress and Senate for by the Republicans that have been pushing for that legislate or that judicial protection for companies, that I don't think there's too much of a risk of a lawsuit risk against companies like Tyson. I think right here, Tyson is really suffering from the headline risk around possible lawsuits, possible litigations from people that had COVID or maybe lost someone due to COVID, that are saying that Tyson was maybe negligent in those working conditions, and that's why those people got COVID. I think it's a very hard case to make, though. Even if we don't get some kind of legislation that says that you can't sue these companies, which I think is likely that you get some kind of legislation protecting them. But even if we don't get that, I think it's a very, very hard argument to make, a very hard case to make that these companies were actually negligent or caused, some of those infections. Okay, so if you've got a company that is down, is down from its peak there, it's actually pretty well flat for over the last 5 years. Let's see what kind of a dividend it's paying. 2.77%, not real high. I would want to look at the balance sheet here to make sure that it's not too heavily indebted. Okay, so they've got about $1.4 billion in cash against $12 billion in debt. So that worries me a little bit. I want to look at the debt on the balance sheet. I want to look at the debt and see how high it's gone, how fast it's increased over the over the last year, to make sure that's sustainable. Okay, because like we've been talking about with a lot of these companies, Boeing, American Airlines, a lot of these companies, especially even in the retail space, they've put on so much debt over the past year that they're going to start seeing that interest expense rise. Okay, and these companies, for a lot of them, especially like Boeing, the airlines, the retailers, their margins weren't that great to start with. Okay, they were making maybe 5% net profit off of their sales as it was. Okay, now you factor in the fact that sales aren't going to rebound immediately. Okay, especially for airlines, especially for Boeing, these capital companies. Sales aren't rebounding that fast. Okay, and then you tack on this increased interest expense. right? And their earnings are just going to be flat. Okay, their earnings are going to be flat for several years. They're basically going to be zombie companies because they're going to be a lot of them aren't going to be able to cover their interest payments, or just barely going to be able to cover their interest payments, which is going to mean, of course, again, no earnings. So you definitely something you got to watch for. I would look deeper into Tyson to see what it's doing. Now I will tell you, okay, so anything in the agricultural space, you got to think about how the crop prices are affecting that producer, that industry, okay, that part of the sector, because crop prices are at like 15-year highs. Okay, corn's at a 15-year high, soybeans been pulled up with it. A lot of these ag prices have been pulled up, on bad weather and inflation and that kind of thing. So how does that affect Tyson? Obviously, I think meat and poultry prices are going to have to be pulled up by that. But if it's these meat and poultry farmers are having to pay higher prices for their corn, for their feedstock, that's going to weigh on that. They're going to hike their prices to Tyson to be able to buy that, and that's going to hurt Tyson's bottom line as well. So you really got to think through, how this affects the whole supply chain. How those higher crop prices affect the whole supply chain there. What other question we have? Reviews, Pong. See, Disney and zombie companies always makes me laugh. What is your opinion on meme stonks in general? Okay, great question by Frostbite there. Meme stonks in general, and so I'll just say, yeah, all these stocks that you think you can get 20, 30, 100% return in a day. Everybody's got to learn, myself included. Every once in a while, I got to jump into a get-rich-quick investment idea, and I got to get burned to remind myself why I don't invest in these kinds of memes and these kinds of get-rich-quick strategies. Okay, and so what I want you to do, if you are thinking about investing in GameStop, BlackBerry, a lot of these meme stocks, if you're trying to ride that wave higher, don't use more than 30% of your money. Okay, it's going to give you the best of both worlds, honestly. Okay, if you invest in these with 30% of your money and they double your money, you've still made a huge return. You've still made a 30% return on your money, which is astronomical for a month or a week or whatever the time frame you're in. If you don't get it, though, if they do fall, and a lot of these, we saw Thursday, a lot of them came down hard, and eventually all the short sellers are going to be out of these stocks. They're going to give up there, and the people holding the bag are going to be the retail investors. And don't tell me you think this is a good long-term price for GameStop or some of these other companies. Okay, just look at the options pricing. Look at the put prices for GameStop. The July 2021 put prices for GameStop. So the people buying puts against that stock, they're valued at as if the stock is going to go back down to like $40 a share, right? So that's got to tell you something. That's got to tell you the market mentality on this stock. Okay, so you're in these stocks for about 30% of your money, and yeah, if they lose 90% of your money, yeah, it's gonna suck. But it's not. You're not out all your money. Okay, you're still in the market. You're still making money with this other 70%, and you can still look forward to investing. Okay, what scares me is a lot of people they're gonna follow these stocks, all these hot stocks, these theme stocks like GameStop and Nokia and that Naked. They're going to be into 100%, and yeah, like I said, like we did that example, they're going to be down 70% in a day. They're going to be down 60% in a day, and it's just going to destroy them. They're going to be. This is the kind of thing that causes people to commit suicide. Okay, and it's a tragedy that they bought into social media bullshit that they were going to get rich quick, and then their life is ruined. Okay, so I'm not saying don't invest in some of these stocks, but just be careful with it. Put a portion of your portfolio to it, not all of it, and you'll still do really well. You'll still do really well if that investment works out. But don't think you're going to be able to do it all the time, every time. Josh wants to know, $5 super chat. I appreciate that. Thank you. Do you think oil is dead? What do you think about producers, Oxy, APA, Schlumberger, SLB? I don't think oil is dead. I mean, come on. I mean, yeah, longer term, 2025, 2030, then we're going to have obviously more electronic vehicles on the road. But passenger vehicles is like 10%, maybe 5% of oil demand. Okay, you've still got commercial vehicles, you've still got air travel, you've still got all these other uses of oil that the EV technology just isn't there yet, and isn't going to be for years to come. Okay, even in the passenger space, the EV electric vehicles sold right now is just 2% of the auto market. Okay, 2%. So don't tell me that EV is going to suddenly going to take all this oil demand off the market. Okay, the right now, it's all about that demand. Okay, we've got lots of supply, and I think so. So you've got at least 3 to 5 years. I'd say at least till 2025, where you can be in some of these oil stocks for the rebound. We've been in oil stocks since about October in the 2021 portfolio, and we made 110% return on Diamondback Energy. We made about a 54% return on Devon Energy before we sold that and took profits on that. And I think a lot of these, I'm in Chevron. I'm over $100,000 in Chevron with those covered call strategies that we talked about on Friday. I think these keep on running for at least the next 4 years, 5 years. So I think you can make some very solid dividend yields and some returns over at least the next couple of years, and not really have to worry about this whole oil is dead argument. What else? What's tomorrow looking like for the day trader? Your guess is as good as mine. I think the overall market is probably going to be weak. Maybe you get a dead cat bounce on Friday's sell-off and last week's 3.3% down for the whole week, but it's not going to last. I think as long as you have this short seller, short squeeze strategy going on, and all the news of that is just sucking the life out of the market, I think you're going to see the broader general market falling. Because the momentum stocks, the tech stocks that have been leading the market, that have been guiding the market higher, are now second fiddle. They're not the stocks du jour anymore. So people are pulling money out of those, putting them to some of these short squeeze stocks. You're also seeing with like I said, with those hedge funds, they're pulling all their longs off the table as well as their shorts. So that's a lot. That's $3.3 trillion globally you're seeing coming out of the market. So as long as this short squeeze is going on, I think you've got some real market weakness. And if that gets as bad as 10 or 15%, then I think it starts hurting investor sentiment overall, and really kind of feeds on itself. What else? I'm going to look for dividends, SPHD. So Gamer wants to know about SPHD, which is a fund, a dividend fund. I think is that I know it's the spider. It's like the S&P, SPHD. It's the S&P high dividend, low volatility fund, right? So Invesco, a little bit higher as far as expenses. I know Invesco charges a little bit higher rates, but if you're you got to think relative to what? Relative to the rest of the market, relative to tech stocks. It's going to be fairly even, right? It pays a 4.9% dividend yield, so that's strong. It's going to be, it's not going to fall quite as bad as the general market, I think. So here we've got a peak of 39.68, and it's down to 38.19 right now. So divided by 39.68. Yeah. So it's 30 divided by 39.68. So it's down about 3.8%. So right around what the market did over the last week, but it's 5% dividend yield, so it's quite a bit higher. If you're looking for a place to park your cash, if you're looking for a place that obviously is, like I said, is going to be a little bit lower volatility, I think you can hide out in that. It's a very, very broad, diversified fund. So I don't think you have to worry too much about about it getting hit. What's your opinion on Excel? Okay, what's your view on silver? Just talked about gold and silver stocks earlier in the broadcast. I mean, it's not. Yeah, I still see people trying to pump silver as the next short squeeze. It's not. You're never going to get a short squeeze on silver. It's just the index and the market cap is just too high. Look at Friday's action in silver. Okay, the SLV index fund, right? It was almost 4 times the daily volume on the trading, and it only boosted the stock by 1%. So you're just not going to get it. Go over the factors that we talked about in this video, the factors to watch for that next GameStop stock, and you're going to be able to find the companies that have a better chance of being able to get that short squeeze and get pumped. What else? Will Biden be good for the stock market? Another great question there by YakawayTube. I think he will generally. I mean, honestly, if you look at the historical evidence, Democrats have been better for the stock market on average, just because they tend to have more fiscal stimulus, more government spending, which boosts asset prices. I think actually, as we're for this year in particular, I think that's obviously a something that can be positive for the markets. Okay, whether it's good for the long-term debt situation of the U.S. or not, I don't think it is. But hey, as an investor, I want the government pumping as much money into the system as they can, because I'm benefiting from those asset prices. Okay, those asset prices are getting pushed up because all that money from the government isn't being spent. Record high, 13% household savings rate is just getting pushed into stocks, pushing stock prices up higher. So yeah, spend away. I'll benefit from it on my stock prices, and I don't know, use some retirement accounts so I can save on taxes when those taxes come, because taxes are coming. What else? AMC details. So I see a lot of people asking about AMC, and I wouldn't touch it. I mean, AMC is equivalent to GameStop here. Okay, it is a company that had a very tough business model, very tough business environment, but people just jumped on it. So invest in AMC if you want. Don't tell me it has any kind of value close to what it is right now. AMC, okay, when are they going to be able to show movies? Okay, at a capacity. Okay, this is another one that had a very poor profit margins. So let's just look at what their profit margins were. And for this, we'll probably have to go into Morningstar to get a little bit longer term results here. Okay, so I mean, there's two things here. If you're looking at AMC as just a short squeeze, then it only depends on how many people are going to invest in it. Okay, so yeah, the short squeeze has been working. People have been taking it as the next GameStop or equivalent to GameStop, $4.5 billion company. So it's not huge. Volume was almost six times the average on Friday. So you've got a lot of people hitting it, and they've got a fairly low share count. Shares outstanding, 287 million shares outstanding. So quite a bit more than GameStop there. But the shares short as a percentage of float is pretty high, 38%. So I mean, obviously it is possible that it is a short squeeze opportunity, but if you're looking at it as a long-term investment, no way in hell, because there is no way it is worth this $4.5 billion company, when just probably a month ago it was maybe, let's see where it was. Okay, so it was a sixth of that value. Just a month ago. So you got to ask yourself, the value jumped by sixfold over the last month. Why? Was it on fundamentals? Was it on the business doing better, or was it on just this? I won't say market manipulation, because I don't think it was market manipulation, but it was just on that investor short squeeze interest. Okay, if you look at AMC, the company, and you go back here to maybe the financials, and you look again, just like we did on those other stocks, you look at the profit margin on it, And then you think about, okay, how much debt has this company put on in the past, in the past year just to survive? Okay, so this is still loading. I don't know why that's taking so long to load. But okay, this is funny actually. Total debt $11.3 billion. So even as the market cap of this company, even as the market value of this company has increased sixfold, it's still got twice the amount of debt, 200% debt to debt to that market cap. Okay, which is just astronomical. Okay, if you consider how much it was selling for earlier. For some reason, Morningstar is not coming up. But and as far as the business model, Comcast said Comcast said it's going to release its movies, its 2021 movies, the same time on its on its streaming network, and you don't take that back. They said it was for a year, but it's not going to be for a year. Okay, they're going to extend that. I think you're going to see a lot of these other producers, the content producers, Disney. A lot of these other people, they're going to release their stuff in the box office as well as streaming simultaneously, and it's going to hit these theaters. Okay, is there pent-up demand? Sure, I want to go see a movie. Okay, I want to go to a theater, but I'm also watching stuff on streaming, and I'm getting used to it, and that's gonna be a serious hit to AMC and the other theaters. They're not going to survive. AMC has a great opportunity here to sell some shares in the market. It's going to dilute current investors, drive the share price down a little bit, but it'll give them some funding space, and maybe they can survive for another few years. But for a long-term investment, I would not touch it. We had a super chat here from Keith. Thank you there. Building up the oil conversation. How do you feel about XOM or the nat gas company NFG? Don't know about NFG. I know XOM has gotten a little bit of analyst love over the past month, just because Chevron went up quite a bit, and so analysts were looking that maybe Exxon was now relatively a good price. I still like Chevron better. I still like RDS Shell. I still like Total better than Exxon. The problem with Exxon is it is just so expensive. It's one of the highest cost producers to produce its oil. Okay, where you've got. I think Chevron's down about $46 a barrel. It needs to be able to sell those barrels for to make money. RDS Shell, Total, they're all around $50 a barrel for that break-even production costs. I know Exxon has come down a little bit, but last I saw, the estimates were right around $70 to $80 a barrel. Okay, so I think Chevron or Exxon is still having a hard time making money off its production. I think it's very hard for oil prices, for WTI to get up to that $70 or $80 a barrel. Once you get up to 60 or so, I think OPEC is going to bring a lot more of their production back online that they've cut, and it's going to weigh on those oil prices, right? It's going to limit how much we can get on oil prices up to $60, $65 at the most, which is still below that cost of production for Exxon. So, I know it's a lot of people like the stock. I know it pays a really good dividend yield, but I just don't think it has as much upside as some of the other producers that are lower cost producers. Yeah, 7.8% dividend yield on shares of Exxon, but I think that's at best that's probably all you're going to get on that stock is that 7.8% dividend yield for a long time. You might get a little bit of a bounce here and there as oil prices go up, but that cost of production is just too high for them. Okay, what else? About all the ARK stocks. Sex robots for customers. What are you saying to the moon? Okay. Okay. All right. Well, we're heading on an hour and a half for this live stream. I thank everybody for being here again. I love these live streams, these Sunday live streams, just for kind of reaching out and a little bit more face to face with these. But I gotta go make sure the kids aren't killing themselves out there in the living room. Thank you again. If I didn't get to your question, please ask it in the comments below. Sign up for the daily bow tie, our market update. It's going to come out 9 p.m. tonight. Give you a heads up on tomorrow's market. I'll put a link to that in the first comment down below. So thank you again, and I'll see you in the next video.